Hello, everybody. My guest today is Mohit Lad. He runs a company called ThousandEyes, which empowers businesses to see, understand, and improve connected experiences everywhere. The cloud platform offers unmatched vantage points through the global internet and provides immediate visibility into experience for every user and application over any network, so companies can deliver superior digital experiences. The company is central to the global operations of the world's largest and fastest growing brands, including Comcast, eBay, HP, 100 of the Global 2000 and 60 of the Fortune 500, along with 5 of the 6 top U.S. banks and 20 of the 25 top SaaS companies. Mohit, are you ready to take us to the top?
Yeah, I am. Look forward to it.
It's pretty remarkable. This all started with a $1 million grant that you got in small chunks, huh?
Yeah, so it actually started with a $150K grant that was from the National Science Foundation. And we chose the route of building the company based on really building a first version of the product and taking it to market versus raising venture money. So that grant over a period of time, over the next 2 years, totaled about $1 million. But yeah, small start.
Well, that's great. And what year was that? When did you launch?
So this was 2010. So we started the company officially in 2010 and we launched the product in 2013. But we started selling it from early 2011. And we're just sort of acquiring customers, making sure we really understand what are the problems we're solving for the customers, and then working on from there.
Yeah, so give us a good example here so people can really wrap their head around what you do, because you obviously touch a lot of big brands, but what do you specifically do for, say, one of the top 6 US banks?
Yeah, so we really help people understand how the internet works and how it's affecting digital experience. And so there's several examples of how we help, but the one example that resonates a lot with folks is if you have an online asset, let's say you're a banking site that you're reaching your consumer users that are all over the world, and you're relying on this public best effort internet to actually reach them. And we help them, help our brands really have this Google Maps like view of what the red is and how can they actually route around it. So you would be still able to get a great amount of reachability to your user base. So that's one use case. And the same technology also works when you are a large enterprise organization and you're going to cloud-based applications like Office 365 and Salesforce and all these apps that are outside, because you're still dependent on this internet, which is outside your 4 walls as a network. So we're really helping people understand these complex environments and help them run their business and ensure the best digital experience for their customers.
And so what's an action someone might take once they start using you? You make the invisible visible. They see red spots. What do they do to correct the red spots?
So oftentimes the most basic things people get into when there is an issue is gathering 10 teams, the app team, the server team, the network team, the infrastructure team, and nobody knows what's going on. So just the starting point of where do we even start to look at where the problem is really important. So one of the first things we do is let them have a very clear understanding of the application is fine, the servers are fine, the network is a problem. So the rest of the guys can go. Now the network team, it's not your network, it's the internet. So, okay, now that we know that it's the internet, which part of the internet? And then you can understand how do you fix it. So for example, most online businesses would have multiple providers that they use at their data centers. And once they know where the issue is, they can move traffic away from one, move it towards another. If you're using a CDN, and one of the areas that the CDN has is problematic, then you again help them understand what needs to be fixed.
So if a company has a highly trafficked pricing page and they want to knock a couple of milliseconds off the load time because that'll increase conversions by 3%, they might use you to figure out how to get those milliseconds back.
Yeah, correct. And like your application in your data center might be really fast, but when it's transiting over the internet, especially as it goes to regions like Asia and Africa and so on, the user experience can be really bad because you're covering large distances over public environments. And
interesting.
Once you know what paths people are taking, you can start to make the experience better by optimizing around it.
Interesting. Okay, and give me a general sense here. I know you probably have tons of different customer stories, but I'm going to try and force you into an average just because we're short on time. I mean, are we talking average ACVs here in like 10 grand, 100 grand, a million, 10 million? Generally, where do you play?
Yeah, so we're a private company, so we don't share financials, but we have a ton of customers that are anywhere from the 100K range to a few $1 million in annual spends. Right?
Okay.
So good. It's really important to be connected to your customers as a consumer brand, as well as to provide a continuous, highly productive environment for your employees. And so from a standpoint of the risk and the importance of the internet, this is a big deal.
Mm-hmm. Yeah, so I want to talk more about that, but let me, in terms of security and things of that nature. But first, color the team for me. What's the team size today?
The company?
Yeah.
Yeah, so we're about closing to 250 employees now, and we're headquartered in San Francisco, offices in Austin, London, New York, Japan as well, and growing at a fast pace, including a recent office in Dublin.
That's great. So of the 250 people, walk me through your sales machine. So SDRs, AEs, customer success, what's the ratio between all of them?
Yeah, so on the sales team in general, and this is sometimes it's a little hard to decouple a certain set of functions. For example, we have a customer support function that engages a lot with customers, and they would be also helping sometimes in a POC if there's a certain element of integration working and so on. But I would say the sales team at this point, if I combine everybody on the sales side, including SDRs and so on, would be somewhere in the 70 to 100 range.
Okay, 70 folks there. And then, a big debate right now with CEOs I interview that are doing anywhere between 60 and 200 million bucks in ARR. The customer success role is really important to drive expansion revenue, but people have tons of different models in terms of incentive structure. Some of them are quota carrying, some are not. Some it's like a pool bonus. How do you generally incentivize your customer success team?
Yeah, so customer success means different things in different companies. For us, customer success team is actually more of a technical team that solve issues. So they're not the team that's renewing customer accounts. They actually engage with the customers to drive adoption, to make sure that the customers really understand how to get the most out of the platform. We actually accept we built that looks into taking care of renewals, and that also is responsible to make sure that they're quarterbacking any kind of coordination and so on. And that team, you would incentivize them based on a renewals target, which is fairly standard on the SaaS side of the world.
Is that the AE that initially closed the deal that stays with the account, or there is a pass off?
Yep. No, so we don't pass off entirely because we work with enterprise customers and all our customers continue to grow. So we need an ongoing relationship, but we would add a team to the team that would close the account. But then we would have an account management team that would add on to it, and they would be the quarterback for the relationship while the sales team will continue to engage. And look, our sales team is not transactional where they will disengage if there is no deal. The
Sure.
idea of the sales team is they're invested in the success of the customer. And oftentimes we don't have a customer that is buying in a quarter, but our team is still engaged heavily to make sure that they're getting the most value. And this is something that I think entrepreneurs should realize is you want to create some division of responsibility so the account management can own the renewals, but you never want the sales team to be only focused on new dollars and forget the customer otherwise. The team's responsibility is to make the customer successful.
Yeah, 100%. That's why these SDR to AE to customer success to onboarding is such a critical relationship. That's helpful to understand. One of the things, Brian Halligan, when he came on, talked really importantly about how pricing axes enabled him to drive significant expansion revenue. And that was a critical moment for them because that's how you get really incredible exponential growth. So for you, I'm going to say I'm a sample customer. Let's say I sign right now for $100,000 ACV account. Over the next year, I mean, what would you expect me to expand to in my next year's contract?
Yeah, so a typical customer, let's say they sign up for $100,000, they would focus on making sure that they can understand and improve their experience for like the 2 or 3 key apps that they care about, or the 2 or 3 key apps that they're having some concerns or problems around. And as they see value, they would add more apps, or they would add more coverage from a monitoring standpoint, or they would say, hey, security team, this is really cool and very useful. You guys should look at it as well. So our accounts would go from 100K to a few $100K to $1 million. The customers that are spending multi-million dollars with us, they all started in the 50 to 100K range.
Interesting. Okay, so I mean, is it fair? You can kind of fairly predictably kind of put a pro forma together and assume accounts are essentially doubling in the first year?
We have a very predictable model in terms of growths, but over time our land sizes have also gone up.
Yep.
So when you model something that you want to model accurately over the last 24 months or 36 months, and your land sizes are also increasing, that changes the model.
Yeah, it makes it difficult.
At this point we're sort of continuously adapting it, but we have a very heavy customer retention, plus also the customers continue to do more with us. And we focus on mid to large enterprises, right? So we have 8 of the top 10 banks. We have 60 plus Fortune 500s. We have about 110 Global 2000s. And these are not easy customers to get into business with. They're really hard to sell to, and we're proud of the fact that we've acquired them as customers, but they continue to grow with the company, and a lot of them are on multi-year deals to begin with when they start engaging. So
you said you're really proud of your really high retention. I mean, I would consider best-in-class gross retention before adding back expansion to be kind of north of 97, 98%. Are you guys best in class?
Yeah, we're best in class. So the retention ratio that investors often focus on is the retention with growth, the dollar rate revenue retention. And we're best in class there. But when I take that out and just look at net retention, we're still best in class.
Hold on. Break. Sorry, I don't understand the difference. I look at obviously net revenue retention being north of 140% being best in class, and gross being above 97% being best in class. But how are those different? How are those two things I just said different than your two metrics?
No, so the two metrics are right. There's retention, right? There's dollar retention, and then there's dollar expansion. But the terminology is often confusing in terms of different companies say different things. When they say DRR, they're including growth.
Okay. So we're talking about the same thing.
Yeah. I think both metrics are equally important, and both metrics are really strong.
Yeah. So just to be clear, I would consider best in class net revenue retention to be north of 130, 140%. You guys are in that range?
Yeah, we're in. So here's the thing about DRR. We're in the range, but DRR is also not point of time. So when you look at these revenue retentions and so on, oftentimes what company would do is they would look at one point and then tell you, hey, our retention. But we actually track it across the entire cycle of the growth of the company. So we're constantly tracking that on a trailing 12-month basis as well.
Yeah. So help me understand that. Most people will track net revenue retention, obviously, on a cohort basis per month. So you'd go look at what signed up last month, or sorry, a year ago, and look at what it is today. You're doing that as well?
Yeah. So if you look at some of the S1s that are filed and so on, the revenue retention is done more of a point of time basis versus like a continuous graph.
Oh, I see. Of course. Cohort analysis.
Yeah.
Yeah. Very good. Okay. Listen, if you're looking at S1s, it means you're thinking about going public. So you're past 80 million bucks in ARR.
So again, unfortunately, we cannot share.
Hey, look at the smile, guys. Look at the smile on this, guys.
I will tell you this, that we're looking at a two to 2.5 year horizon to be IPO ready. And the reason I say IPO ready is I think going public, not a goal. It's one of those things that, effectively is like a milestone. But what we want to focus on is making sure that we continue to grow as a business and continue to really acquire great customers. So that's really what we're about.
Yeah, that's fine. And then I won't push you there on obviously revenue metrics, but in terms of total customers you've scaled to today, what general range are you at?
Yeah, we're at 500 plus customers at this point of time.
Okay, got it. And again, most of these, big kind of enterprise-like accounts.
Correct, yeah.
Yeah. Now,
so for us, every logo is not, customer logos. There are companies that work with small businesses that can say we have 5,000 customers, and then our focus is like the really high and mid to high end of the enterprise base.
Yep. And look, I mean, you 500 customers, you kind of gave me an ACV earlier of $100,000. That should put you at about $4 million a month today, or about 50 million bucks in ARR. I mean, generally, am I directionally correct?
I would say like you have to track us for the next 2 years, and you'll get all the details, and then you can go back to the historic financials we would have in the S1.
I don't like waiting. But look, you gave me $100,000 ACV, you gave me 500. I'll just do some multiplication there. But listen, why set the? I mean, look, a lot of security companies I've talked to, Malwarebytes, KnowBe4, Stu. I mean, they all kind of want to go public, right? Because ultimately, by going public, there's something to be said about being a security company and being more bona fide by being public. You can close deals faster. I mean, why, besides that reason, why else would you go public? There's plenty of money in private markets right now.
Yeah. So just to clarify, we're not a security company. We focus on more network performance, network intelligence, digital experience, but some of the use cases we track cover security. That aside, in general, companies go public for various reasons, including they need cash or employees need liquidity. For us, the primary reason that we would look at is whether it creates more customer confidence and helps us from that standpoint. The fundamentals of the company are very strong, and given we were built on a small grant and customer acquisition, Fortunately for us, we're not one of those companies that needs cash every 12 months to continue.
Oh, hold on, Wahid. I have to push you on this because I was just going to say, I really would have loved your story if it was just $1 million grant and you were really smart and you figure out how to, have VC in terms of vested customers and instead of actual VC and being diluted. But you've raised pretty significant capital. How much capital have you raised?
Yeah. And so let's talk about that. The way we raised capital is when we believe that we can use capital to scale the company. And what I want to point out, for example, is our last raise was in December 2015, and we haven't raised since then. And so anytime we raise, it's not because we need the money, it's because we believe that capital infusion will take it to the next level. And that's the difference between companies that need to raise every 12 months. Otherwise, they actually end up not being able to operate, right? And that's not the mode. And what happens when you raise a Series A on a slide deck, and then you go and build the product, by the time you've exhausted your Series A, you now have to raise your B because otherwise you can't take it to market. And so that's different in companies. And we're not the only ones. There are companies that are more organically built in the early days, where the growth is slower in the early days, but it's more sustainable because your fundamentals are really strong.
Yeah, that all makes good sense. That all makes good sense. But total to date, you've raised what, $60 million?
We've raised about 60 till date, yeah.
Yeah, and I think according to PitchBook, that last valuation was about $273 billion. So, I mean, look, that's nothing crazy, right? I mean, that strikes me as someone or a company that's being financially disciplined and not trying to be some unicorn with no revenue.
Yeah, and look, we've had revenue since the first year, right? So we were not one of those companies that raised at a high valuation with a slide deck. And that's what I'm getting at is everything, the only currency we care about, we don't really even care about valuations. And the only currency we care about is customers, customer bookings and growth, and like really making an impact for the customers as well. I was at an event where we announced our cloud report recently, comparing the different cloud providers. And there was an engineer from one of the banks, one of the large banks there. And at the end of the event, he was one of our customers. He came and just gave me a hug and said, "Hey, there are so many times that you guys actually in the light on where the issues are, when historically we would have just been yelled at for being the network guys that were creating problems." And so those are the kinds of moments that we really, really feel good about, like making an impact on these lives.
That's great. Quick last two questions here because we're out of time. Growth rate today. Obviously, you're at big numbers now, so 3xing year over year becomes more difficult. Last 12 months, is it fair to say kind of high double-digit growth?
So, Nathan, I wish I could go into all kinds of rates, but again, as a private company, we're at a board level.
You already did, though. You already did, because you said you're eyeing an IPO ready in 2 to 2.5 years.
Yeah.
I mean, and you study S1s, and you look at any S1s recently, they're looking at anywhere between, call it 30 and 80% year over year growth. So the statement I made was just based off what you already said.
Yeah. So so I lost you for a second there. But based on our historic and our future forecasted plans, we're in a really good class of companies that have gone public, and we feel really good about it. And at the same time, we're not the kind of company who needs that crazy amount of cash to get there. So,
anything else you want to add to that?
No, we're on a good ramp here, and I feel excited about the next 2 years ahead, 2.5 years ahead.
That's great. Last question before we wrap up with the famous 5. Aggressiveness. I want to get in your head here. I'm not interested in your own number, but what I am interested in is theoretically, if you are going to go acquire a $100,000 ACV account, how willing are you to spend money to get that account? Are you happy with a 12-month payback? Will you push it to 24 months? How aggressive are you being?
I'm losing you. So the way I look at this from a sales and marketing expenses or cost of customer acquisition is more around how it trends over time. And so the suggestion I give to entrepreneurs is you cannot ever look at cost of customer acquisition in vacuum, nor can you look at sort of a metric and say, okay, this is good or bad. So when we think about cost of any kind of customer acquisition and the ratios, we tend to look at how do we model this, and historically, has this been moving in the right direction? As in, our return on the customers gets sooner and sooner, or are we actually going worse?
Mohit, why do you make that statement that getting sooner and sooner payback is actually better? A lot of companies, as they prep for IPO, they actually push their dollar-based CAC up from $1 up to say $2. When you look at the last 12 IPOs, a lot of them are in the $1.20 to $1.80 range for a new dollar of ARR.
Yeah, and look, there's 2 models, right? So there are companies like Atlassian, and if you look at them, they have actually got some really good organic growth, and then they have started to create a strong base and scale. And there are moments of company when you want to change the ramp rate that you invest in sales and marketing costs. And the returns of those costs are not in that quarter. They're returned like a year later or 4 quarters later or 5 quarters later. And this is why I'm saying that when anytime I consider a model for what our current expenses are and what our future expenses will be, they have to trend in the right direction. So the fundamentals of the company won't be good. If the dollar you spend to acquire a customer is getting worse and worse and worse, then that's not good for the business.
Yeah, Mohit, but that's what I'm asking. You use the word worse. There are a lot of companies that say if you can't push your dollar-based CAC up, assuming whoever can spend the most to get a customer actually gets the customer, they would actually say spending more is better because you have confidence in your economics where you can afford to spend more. You're saying the opposite. You're saying, no, that's worse. So just to be clear, I want to make sure I'm understanding you correctly. You're driving your dollar-based CAC down.
Yeah, so here's how I look at it, right? There's two things. Can you get more out of a customer over time? And if you believe you can get more out of a customer over time, then you can afford to invest more in that customer. In general, when we think about cost of customer acquisition, we want to trend it down over a period of time. And that's the way we think about it. We don't want our cost of customer acquisition to go on. So I don't know the financials of the companies that want to do that.
Well, you just said it. You said if the lifetime value is higher, you're happy to push dollar-based CAC up. You're pushing it down, which means for whatever reason you believe lifetime value is getting less over time.
I said, no. What I said is if you can create a scenario where for a specific class of customers, whether it's a specific, let's say you want to go after a federal market because you believe that if you go after that specific market, the model of the consumption of the product is different, but over a period of lifetime, like if the federal customers do 6-year contracts which is non-standard in your business for other customers, then you can have a different model there for cost of customer acquisition. That was my point.
Yeah. Okay, fair enough. Gotcha.
Make sense?
Yep. All right, let's wrap up quickly here. Famous 5, number 1, favorite business book.
I would say the best book I enjoyed was The Hard Thing About Hard Things.
Yeah, Ben Horowitz. Number 2, is there a CEO you're following or studying right now?
The CEO I probably respect a lot is Godfrey Sullivan from Splunk.
Godfrey Sullivan from Splunk. Good. Number 3, what do you guys use for your billing system?
For customer billing?
Yeah, like Zora or
we use Zora, yeah.
Okay, got it. Number 4, how many hours of sleep do you get every night?
I would say between 6 and 8.
Okay, so pretty good. And what's your situation? Married, single, kiddos?
I'm married. I have 2 kids.
Married, 2 kids. And how old are you, Mohit?
I'm in my late 30s, but I won't be able to use that line next year. Let's go with that.
I like it. Positioning. All right, last question. What do you wish your 20-year-old self knew?
So that's a good question. I think the main thing I'm surprised by if I look back is how quickly the role of a CEO changes. And sometimes when you make that transition, you don't end up doing all the things that make an immediate impact as easily as you scale. So I would just say if I had to go back and inform my 20-year-old, I'd say be prepared for more accelerated changes in your role than you would expect.
Guys, there you have it. Mohit founded in 2010 on a very small grant. Now 250 people, ThousandEyes, again, helping teams, really network teams, make really what's invisible visible so they can go attack the right problems, whether it's website loading time, a cybersecurity use case, or other things. They have over 500 customers paying, called on average, $100,000 ACV. Net revenue retention, world-class in the 130-ish, 140% range, with an eye to being IPO ready in the next 2 to 2.5 years in Mohit's words. Based between San Fran and other remote locations. Mohit, thanks for taking us to the top.
Thank you.